Yeah, look, we've been invested in Challenger since the inception of the firm, really. What we like about Challenger is the exposure it provides us to the ageing population, to retirement savings. When you look across the financial services landscape, the fastest growing segment of the market is retirement savings. It's driven by just the pool of money transitioning out of superannuation into retirement savings, demographic changes, all the things that everyone knows very well. Challenger, with the provision of annuities, is providing that product that increasingly we're seeing a lot of the industry funds, a lot of the IFA groups recommending to their retiree clients. That is, you're getting your pension, that's great, but that doesn't get you where you need for your standard of living that you want to have. You need some other product to supplement the pension. And that's where the Challenger annuity product comes in. So we like that thematic that Challenger has. It has a lot of growth, a big growth tailwind at its back. Challenger is also a stock that tends to polarise people. People tend to look at it somewhat superficially at times, and get all upset about the capital intensity of the product. They look at the margins in the business, how is it sustainable, etc., etc. But when you look at and break it down, the margins that Challenger generate off its fixed interest portfolio are no different to the margins the commercial banks generate off their lending practices. It's exactly the same. It's a more capital intensive product, that is for sure. So that goes to the valuation you want to ascribe to Challenger. But when we look at this company and look at the quality of its credit portfolio, even during the GFC, they had bugger all losses on the fixed interest portfolio. They did have some losses in the GFC, but that was on infrastructure. And that was more due to the gearing that was inherent in infrastructure plays prior to the GFC, as opposed to a bad investment decision made. So we look at Challenger and we dive deep into the accounts and get an understanding of where it's going on. We just think the market massively overestimates the risk associated with this business. Not enough focus is on the growth, and consequently Challenger just comes out. There has been times in the last 3 or 4 years where analysts have been forecasting declining earnings profile on Challenger. Forecasting a margin is going to slip. It's unsustainable at these levels. Year in, year out, they prove the market wrong. Year in, year out, the earnings keep going up and the share price keeps tracking higher.